Welcome back to Rich Dad Stockcast. I'm your host, Denney, and today we're talking about one of the most powerful paths to financial freedom available to everyday people using stocks the right way. Now, most people think stocks are about buying low and hoping that they go up, but that's not how the wealthy use the market. They use stocks to generate cash flow, control risk, and build income that eventually replaces their paycheck. So today we're breaking down how to actually build financial freedom using stocks, not speculation, not guessing, but strategy. And joining me is Rich Dad expert Andy Tanner, who teaches people how to turn the stock market into a tool for income and independence. And before we get into it, make sure you go to stockcastbonus.com, grab your free investing tools. If you want to move from working for money to having your money work for you, that's where you start. Andy, welcome back.
Great to be with you, Del. This is going to be really a fun topic. Excited to dive in and see what I can offer.
I know you've got a wealth of knowledge here. You do this every day, and I'm excited. But before we jump into that, Stockcast Bonus, great resources there, especially for the newcomers to our channel. What do they receive when they go there?
Well, free stuff, number one. So that's always good. You can pick up your free stuff. But when I'm asked that question, I often answer this way. There's people that really enjoy watching things and consuming and learning. And then there's those that know that there's doing as well. So when we hear something, we want to be able to implement it. And that means recipes. That means step by step. That means systems. And so we have downloads there. We have free stuff there where people can really get a plan together and begin a new life as an investor rather than just someone who dabbles in investing, which is a big difference. To be a true investor is about who you become. You know, I often call 401k people participants, not investors. They're participating in a program. They're participating in the market, much like someone might do surgery without a medical license, without knowledge. So go there, get knowledge, free stuff, and it's got your name on it. So head on over and pick up your stuff.
There we go. Perfect. Now, speaking of participants, that kind of segues perfectly into my first question. People invest decades into the stock market, right? Be it their 401k or whatnot. Why do most people invest in the stock market for decades and still never reach financial freedom?
Well, I think there's a couple reasons. If you look at a lifetime of investing, Warren Buffett will put this in a compound calculator and say even 1% in fees is enormous. So you're starting out on a headwind. And if you take a person from age 20 to 85 when they die, so you basically plan on a 65-year period to set up your family, set up your legacy, whatever, before you check out. If you take 1% off of that, it's massive. It's life-changing. It can take almost 40% of the entire amount out. So the first thing is fees. The second thing is you're going to be almost guaranteed to be below average. And here's why. The most important word on Wall Street is assets under management, or term. The most important term is assets under management because they make money off fees. They take a portion of that pie, and whatever number that is, it could be 0.5%. Doesn't matter. They skim the top. And the more they get, the less they have to take. Not that they would want to take less. But if you go to the SPIVA report, S&P versus actively managed funds index, you'll see that 95, 90 of them, 89, it always depends on how far back you go. I'd say in the last 15 years, you're probably 89% of them, 90% fail to beat the S&P 500. Why is that? Well, because they copy the S&P, so most of them can't beat the S&P because they can only copy it. And then if you charge a fee to be average, you can never hit that average. So the way they diversify and the way they just say, hey, we're just going to put you in the market and, skim the top, a person doesn't have a chance to be atypical. So an atypical investor is someone who strives to beat that average. And as Warren Buffett will tell you, very few people can do it. John Bogle will tell you, very few people can do it. Why? Very few people know how to trade. Very few people know how to collect premium from the markets. Very few people know how to do a fundamental analysis. And so Warren Buffett would say that diversification is a confession that a person doesn't know how to analyze a business. So that's why. Would it be surprising to us if I said, I'm going to go and be a concert pianist, that's what I want to be, but I never took a piano lesson in my life. I knew nothing about the instrument. Would it make sense to say, I'm going to go solve crimes and be a homicide detective, never go to the police academy? So I think it's those two things. I think it's the combination of the headwind in a program that is built to be worse than average for most people that can't beat the S&P. So there's that system side of it, but then there's also the individual side of it where if people don't know how to invest, why would we expect them to be wonderfully successful in anything they didn't train on, work at, and really decide to become an investor rather than just invest? I wouldn't expect myself to do, very well in open heart surgery. Would it be, it's kind of like saying, Andy, how come you're not a good heart surgeon, right? How come people aren't great investors? It's the same reason. It's an educational issue every single time.
Well, tell me about education. We talk about atypical investors. So maybe someone listening is like, well, atypical, then do I need a Harvard education to trade stocks? What would you say to someone like that?
Well, it's a different education for sure. Strange as it may seem, or maybe not so strange, is that let's say that there are certain things that it is very, very, very difficult to learn in any other way than doing it. For example, if I were to give a child a book that says how to swim, and inside the book it described buoyancy principles and which side of the pool to get into and what water wings are to start, and what's a breaststroke and what's a freestyle, what's a butterfly, all these different backstrokes. And you have that kid read that book cover to cover, study it, and then you give him a test on it, and he gets an A. Every single picture's right, and every diagram is identified, and then you throw him in the pool and he drowns. Yeah, because swimming happens. If you have swimming lessons, they happen in the pool. So stock investing, in my experience, I've never met anyone that read a book on it and went out and crushed. Never. Everyone I know learns it by doing it. And the best way to shorten that curve that I know of is through mentorship, to have a rich dad to guide you as you do it, to have someone who's done it thousands of times that just doesn't even get our heart rate up. And so education in stocks is a skill acquisition, not just a knowledge acquisition. And that's different. Having knowledge of what options are and having skill with them, having knowledge of equities and having skill with them, having a knowledge of financial statements and then advancing to skill. That's the difference between competency and proficiency. Competency means understand. Proficiency means I can do it. And that's why we have our education continuum, where we take people from ignorance, where they're not stupid, they just haven't focused their genius on that area. Then we take them to awareness, where they have aha moments like, you can do this? Really? You can do this? Yeah, you can do this. Then we take them to competency, where they say, okay, I understand. Then we take them to proficiency, where they say, oh, not only can I understand, I can do this. And we go with proficiency really quick. It's important to get there quick because you don't have time. You're compounding. Money, rate, and time. Got to compound. Got to get going. So that is the difference educationally from just reading a book or getting some knowledge or whatever, and actually practicing and doing it under mentorship, so you can be guided and avoid a lot of mistakes.
Fantastic. Now, I love that principle of the education continuum, just from ignorance to awareness to proficiency and so forth. Now, speaking of probably going from from ignorance to awareness, why do most people ignore cash flow when using stocks?
So I guess it's first of all, it's emotions. People get excited to be able to buy low and sell high, and it makes them feel like they made a smart decision. Also, people make a lot of money when they churn. Brokerages can charge fees for that type of stuff. They encourage churning. But I got to tell you, the mindset of cash flow, it's always that same analogy I always use of a goose that lays a golden egg. No one buys a goose hoping the price goes up next week to sell it. They're buying it with an eye on the golden eggs and the lifetime supply of wealth. I I can't help but talk about Exxon every time. I think it might be one of my favorite stocks I ever bought. As of this recording, it's sitting at 150. And what people don't realize is, if you buy that in the 40s in COVID, when I bought it, well, the dividend now is on that. I didn't spend $150 on the stock. So people say the dividends, this or that. No, my dividend's over, it's about 10% now, because the amount they pay every year is 10% of what I paid. And I just think money in, money out. I threw money out, I got this money back. So 10% there. You throw a little covered call rating on that, you got a 20%, 20% return on some. Why in the hell would I sell that just because it's 140? Then I have no asset. If I sell at 140, I make $100 a share. Okay, I'd earn $100 a share because it's gone up $100 since I bought it, right? 140, 150, whatever it is. And I could take that $100 a share and say, good lucky me, and go spend it or buy another asset. But where am I going to buy another asset that gives me 20%? I've got one in there. Plus, I'd have to pay taxes. So it makes a lot of sense to keep it and think, okay, I'm going to live if I can, get my cholesterol down and get my A1C where the doctor says, and, lose a few pounds here. Maybe I live another 30, 35 years. That's possible. I have family members that have done that. So maybe I got another 30 in me, maybe another 35 if I'm lucky. But you look at the time, and then I look at my children. If I put that in the family trust, my children can get that money paid. They know how to write the covered calls. The dividend will come anyway. The dividend has risen every year for 40 years in a row. Consistent as heck. Why in the hell would you look at price and worry about whether it's, oil's up, so it's high, so maybe I sell now, so when oil goes down, look, just let the machine run. Just let the golden eggs go. Don't worry about the goose's price. Just look at set yourself up with cash flow that gives you a passive income above expenses, and then you can have time back. And if you keep doing it and compound a little more, maybe you have a little money to spend and enjoy that time. Then you focus on the stuff that matters most, like a spouse or child, because then you're truly rich when you got it all, right? When you have the time, the money, the family, the health. I mean, boy, that's the rich life there. People that care about you. It's great.
Yes, indeed. I love where we're going with this. Now, I want to pause this real quick. Let's take a quick commercial break, a quick break, if you will. If financial freedom comes from income and not just account balances, then the real question is, how do you actually build that income using stocks? So when we come back, Andy's going to break down the strategies investors use to turn the stock market into a cash flow machine. And don't forget, go to stockcastbonus.com, download your free resources. This is where you start building real investing skill. Stick around. We'll be right back.
So far, it's been great. I needed a source where I could really enrich my education through stocks. I didn't really have an avenue for it, and it's helped me a lot. The simplicity has really gotten me on the track to where I enjoy the learning as well as it's really solidifying in my mind. And like, they're not just trying to sell you something, they really care about the people that are in the course, and they really do care about you and your personal goals, and what you want to do is to help you and your family and whatever your goals are in life through that. So it's really been great.
Welcome back to Rich Dad Stockcast. Andy, let's get practical. So if someone wants to use stocks to build financial freedom, what does that actually look like?
Well, it looks like cash flow. I mean, you could do it two ways. I mean, if you had a stock that you bought for pennies and it went to the moon, and you sat there and you had $1 billion you could cash in, that money would likely not outlast you, right? You got $1 billion, you said it wouldn't last you. It's just, you got this hourglass that goes slower than the time here on earth goes for you. That's one way. But I think the best way is generational cash flow, to create entities that can create value in perpetuity. And so the cash flow really doesn't have an expiration date on it. It doesn't have an hourglass effect, like a 401k is an hourglass, right? 401k, okay, how much do I have? How long will it last me? Well, the reason you're asking whether or not it'll last you is because it's not producing cash. It's just sitting there and you're selling off your assets to say, hey, do I sell these off too fast, or can I make them last long? So I think that's the big difference, mentally, in how you look at that.
Now, in the, Robert has outlined, and we hear this over and over again, and I love this this quote, financial freedom occurs when your passive income meets or exceeds your expenses. Just a very simple definition.
Yep.
As we look at the primary ways that stocks can generate income passively, what are those? We have dividends, covered
There's a
calls.
bunch.
Can you maybe give us two or three just to bring the listener to awareness?
Yeah, I mean, well, you can start by knowing what stocks are. And people say, well, they're not real because they're paper. That's a lie. That's like saying my house isn't real because I have a deed that proves it's mine. Does that make sense? Like people say, well, I know my gold is real because I can hold it in my hand, and I know my car is mine because I have a title, and I know my house is mine because I have a deed, right? There's something called certification. In other words, in the old days, we had silver certificates, and they were paper, but it said this certifies that there is 1 ounce of silver in the United States Treasury payable to the bearer on demand. It's a certificate. So that's how stocks work. They are certified. They are ownership. So, Apple, this is real. I can hold this in my hand. I can hold the product in my hand, right here. Apple is real, right? The technology is real. It's not fake. The intellectual property is real. It's not fake. So once you understand that stock is partial ownership of a business, it is not much different than if I had a sole proprietorship and I put some articles of organization together, or maybe I have an LLC with a couple of guys in it, a couple of friends or whatever, and we do an LLC and we organize it. We own it, and the paper just certifies that it's what we own. So once you understand that stocks are simply opportunities to own things that you could never start yourself. I'm not smart enough to build an iPhone. Think of that. I get a tap into the genius and results of Steve Jobs because I bought some of his company. I didn't have to do anything but come up with the money. Didn't have to do any work. Didn't have to do anything intelligent. So when there's profits in real estate, they distribute them among the syndication participants. In other words, Marcy and I have some syndication in Texas that we've done, right? And so we have a share of that, many, many other participants. And when there's profit from the value given in consumed rent, when there's profit, they divide those profits among us or distribute them. And so they call them a distribution. In stocks, it's exactly the same. You have a group of people that collectively own a business, and they distribute those profits among those shareholders, and we call them dividends in stock. We call it distributions, but both of them are, doling it out, dealing out the cards, distributing, dividend, whatever you want to call it. So that's the first part. Now people poo-poo that. They say, well, here's a stock that only pays a 1% dividend and inflation's at 2%, and so you can't win. Well, you're not betting on the right thing. I'm going to place a bet that the dollar loses value in 10 years. I'm going to bet you that 20 years from now, the dollar might not be around anymore, right? Barely as the world's reserve currency. Probably still around, but maybe not as the world's reserve currency. So if you look at that in the first half where I talked about Exxon, if you buy this thing cheap and the dividend increases over time because of inflation, you're going to see a cash on cash return in the future. So it's so weird because people say, well, I'm not going to buy a stock for a dividend because it's too small. Well, when you're buying a stock for capital gain, you got 0 out of the gate. Yeah, you don't have 1%. You got to hope it goes up, and it could go down. And so, realize that over time, if you study dividends, you're looking into the future just like you were in your stock. Why are you buying stock? Because I think it'll go up. Well, I'm doing it because I think the cash flow will go up. So what's the difference? It's just that, you'll find stocks that go up and down in price every day. You can find companies where the dividends increased over time or been steady for years at a time, just solid, right? So that would be the first most fundamental cash flow income, is to simply own a business and share in the profits of that business that you don't have to work at. What Warren Buffett says, the lowest way to participate in American business and do it consistently. there is no business that I participate less in than Apple Computer and Verizon Wireless and Exxon Mobil and all the others that we often talk about. Cameco recently, I bought that a couple of years ago because I thought all these AI geeks need nuclear power. Let's start selling uranium, right? So I sell uranium and electronics and banking, and I could never start these businesses. And yet I will receive cash flow on a regular basis by virtue of ownership, not trading up and down.
Isn't that amazing? So having ownership, participating in companies, dividends, one way to generate passive income.
Companies I could never start and that I can own beyond the grave and give to my kids and their kids.
How amazing is that? Now, the next, I want to say next level, but another option trading.
Yeah.
Covered calls, selling puts. How does that bringing us into the awareness phase? How do we generate passive income through that?
So it's a business we get into. I probably wouldn't be in stocks if I didn't have that to accelerate the compounding. I probably wouldn't be in them. But in 1971 or 68 or whenever it was, around the time I was born, I guess, if I can date myself, somewhere around in that time, late 60s, early 70s, we developed an options market in Chicago Board of Options Exchange. What's nice is that's not likely to close. And so that creates an opportunity for me up, down, or sideways, market up, market down, sideways. It creates an opportunity, a place to go play. More importantly, a place to go get value. And all we're doing with options is making promises when we sell someone options. Think insurance. They underwrite a promise. Dell, give me $100 a month and I'll buy you a new car if you wreck yours. And that's basically it. Well, all I need to do is have money to buy you a new car. But the different, and most of those promises go unfulfilled and they just keep the premiums. The difference with options, though, is we want to keep our promises. If I get paid for a promise to buy on the cheap low, I'd love to keep that promise because I'm not buying a wrecked car. I'm buying a company that is solid. It's just everyone in the market was panicking and brought the price down. A solid company. It's a great car. It's not a scratch on it. I get to buy it cheaper simply because the market's opinion is that it's cheaper right now. But I know the real value inside. I've looked under the hood. I do a fundamental analysis. I know it's good. So that's another income. So if let's say you make, let's say you have a stock that's paying a 3% dividend and you buy it and then it dips. And so you get to buy it and get like a 7% dividend just because the price dipped down so far. So now you got 7%. Then over time, the dividend raises, so maybe you get to 8, 9% over a period of years. Then you have your call writing and write a call at 1% in a month. That's 10% a year, 12% a year right there. Next thing you know, you've got a handful of companies that are giving you double digit, not available. 401ks don't do this. You're not having to pay fees. Now you'll pay a little trading transaction, but that's 50 cents. It's flat. It's 50 cents. Worth it to go out and get it. Worth it. And so now we do what we call stacking income. I have my dividend. And on top of that, I stack my call premiums for promising to sell higher than I think it'll ever go or where I'd be happy to sell, or promising to buy it at a price lower than I ever think it might go, or when I'd love to buy it at. And to get extra money for selling high and extra money for buying low is a tailwind of premium rather than a headwind of fees. So if we go back to what we said in the first segment about Warren Buffett saying 1% is enormous, that means a year. What if I get another 1% in a month on an option? Now there's a third one we could talk about too, but those two right there alone, by understanding and understand the education continuum. You might say, I know this. Well, then you're competent. You're along the education, you're competent. Oh, I know all about this. Well, maybe you do, maybe you don't. But how proficient are we? Because 1% is enormous. And so I love hanging out with guys that do this every day. I love it. I hung out with them today. We did a podcast earlier with Noah Davidson and Corey Halliday on the Cashflow Academy podcast, where you get to listen to guys way smarter than me. Listen to my team. They're smarter than I am. The only thing I'm smart is to surround myself with people like you that are smarter than me. But yeah, that 1-2 punch probably not out of the gate getting a double digit, but with inflation, with good fundamentals, with growth. Yeah. I mean, I'm writing covered calls at strikes that are $100 higher now when I bought it. That's a massive advantage to be able to spend $40 to 40 to 50. And now you're writing strikes that, the covered call strikes I wrote on Exxon this month, or last month rather, 180. $180. So if someone wants to buy it for $100, I'd probably hedge it and, buy back or roll out or roll down, probably just hedge it with stocks. But there's things, and that's the knowledge, that's what's helpful. So there's the third way, but first way, get paid out of profits. Second way, learn the options game. It's just like a real estate guy saying, all right, we're getting the rent, but maybe we can get some storage and get extra money for the storage, or extra money from the vending, or extra money from the laundry, or extra money for the covered parking, or extra money for the dog area, or whatever you want to add on there. And you stack that income on top, multiple streams from one asset. Return on investment means how fast do I get my money back? Accelerates that rule of 72. All that stuff starts to come into play.
Ah, that's fantastic. Now, just because of the sake of time here, this has been huge, by the way. Just I've such an awareness for people to understand, hey, we can generate cash flow, income stacking. If someone wants to start building financial freedom, they want to learn how to stack their income, how to options, dividends. What's the first step that they should take? What if they want to learn that third strategy? What's the first step that they should take?
That's an easy one. You go to stockcastbonus.com, get your free stuff, and start going. And there's a myriad of ways that we can cash flow, and I like it so much better than guessing. So go there and start learning the regimen, start learning the habits, start learning the process, the systems to plug yourself into what I believe is just going to get bigger and bigger and bigger. With AI, with labor going to become free, that's going to make businesses more productive, and that helps your moat. If you're valuable and productive and, irreplaceable, you have a nice moat. You have a real strong business. And perhaps the best risk management you can do is pick a great company. And so go to that website, start learning how to do that, and we'll take you by the hand, walk you through it. Beautiful.
Fantastic. Well, thank you, Andy. Listener, financial freedom, it's not about luck. It's about building income that works for you. And the stock market, when used correctly, can be one of the most powerful tools that can make it happen. And again, big thank you to Andy Tanner for breaking this down for us. Now, if you're ready to start building financial freedom using stocks, go to stockcastbonus.com right now. You'll find free tools and resources designed to help you to invest smarter and build real income. And if this episode gave you any sort of value, make sure you like it, subscribe, share it with someone who wants more than just a retirement account. They want that financial freedom. So, listener, you're not here by accident. You're building something that most people won't. Stay smart, stay invested, and we'll see you next time.
This podcast is a presentation of Rich Dad Media Network.